Hi there, welcome to November's market analysis. Let's jump right into the numbers. So, I've highlighted things that I wanted to go over and discuss with you. So, just GDP down 1.7. So, this is across the country, which is not really the best thing, but there are signs that the economy did slow down in the third quarter across the country. However, the local market, so again, real estate is driven by local factors. So in this case, Toronto's employment growth up 3.8%, which is positive. Again, employment, jobs equals housing demand, whether it's renting or buying a home. So that's a good thing for the local Toronto market. And then if you look at inflation overall, again, this is across the country, it's down to 1.4. So this is in the sweet spot. It's below the 2%. It's above 1%, so things are not too cold, not too hot. So this is nice and steady for the Bank of Canada when it comes to setting the benchmark rate. Their next meeting is January the 17th, and after that it's March the 7th in 2018. But again, they're going to look at the data, but also take a look at what the U.S. Federal Reserve will announce today, which is December the 13th. So we'll see how things play out. Um, so a couple things here I want to discuss. So again, I focus on the Toronto market. So you can see detached is 1.27, average semis are 904, and then condos are 555. So the spread is pretty equal. So if you look from the condos to semis, it's $350,000 difference, and then from the semis to detached, it's about 370. So it's a well balanced spread between those types of housing. And then overall from what I call the average prices from compared to November of 2016. So detached in Toronto down 5.1, semi pretty flat, negative 0.7, and then condo market is just on fire at 17.7% appreciation. And again, that's driven, and you probably heard me say this many times, affordability. It's really the only affordable option for someone to buy in the 416 without having to commute for hours and hours and sit in traffic or on the GO train. The other stuff here, we'll get into a little bit more detail. So you'll see the days of market a little bit higher by 7 days, and new listings up 37%. There's multiple factors, but we'll do a deep dive and break it into specific markets because this is across the GTA, which is a massive market, but we'll break it down into the 416 area code. So the next page here, this is detached houses. I wanted to gauge the temperature of the market. You can see City of Toronto in November, there were 812 sales, average is 1.276. And then when I look at sales to new listings and sales to active listings, so this gives me of what's happening right now. Active, it's what's current temperature. And then this is kind of, I don't want to say future, but it will spill over into the following month because this is the new listings that came on in the month of November, and you can see it takes about 22 days to sell. So some of these detached houses will sell in the month of November, but will spill over into the month of December. But again, we look at the ratios; they're 47, 38%. So between 40 and 60 is a balanced market. Below 40 is a buyer's market, and above 60 would be a seller's market. So Toronto is in that balanced, I still call that balanced, but yeah, it's pretty balanced uh, market condition. Houses are selling at 98% of asking and 22, so-called 3 weeks, they are gone off the market. I picked a couple different neighborhoods here. So King City, you'll see it's 30%, 12%. So that's really buyers' territory. They're selling at 93% below asking, and it takes slightly over a month, so 36 days. And again, here it's because the product, there were 21 sales in November, but I should say, having said that, the average price is higher. So King City, bigger homes, bigger lots. It's a different niche market, so they tend to take a little bit longer. However, it is a buyer's territory. Now, I picked Vaughan for the reason, not to pick on Vaughan. Vaughan is a great place, but the average price is pretty close. So again, this is detached. If you look here, detached houses in Toronto and then Vaughan. So the averages are pretty close. Mind you, for 1.2, you get a bigger lot, bigger bedrooms, fence, and all that good stuff. Probably 2 to 3 garages. But I just tried to pick something with a similar average. So in Vaughan, there were 117 sales compared to 812 in Toronto. The sales to new listings and sales to active listings, that is definitely buyer's territory. So you can see 27%, 17%, and they're selling at 97% of asking and close to the 1 month mark. So um, Toronto, as you can see, it's pretty balanced. It's balanced territory, and then once you get into the 905, it's more of a buyer's market. So if you're looking for deals or you want to commute, definitely the 905, there might be some good buying opportunities. And that is based on November 2017. So we get into the semi-detached. So again, in this 416 only, there were 267 sales, and you can see the sales to new listings and sales to active listings 68. So it's at that, 63 is balanced, 68 is getting close to that seller's territory, and you can see they're selling 103% of asking, so 3% over their asking price, and they're again 20 days on the market, so about 3 weeks. So it's moving, it's healthy. Um, Again, there's just generally a lack of supply in this city. Now, once we get into the condo, it's a completely different story. It's really hot. So if you look at C1 again, so this is Yonge Street West, Bloor, the Lake to Dufferin. There were 440 sales. 615 was the average, and then you can see the ratios are 70-76, so that's seller's territory, selling at 100% of asking within 18 days. And C8, so that's Yonge East to the DVP, Bloor to the Lake, 156 sales, pretty much the same average, 619, and again 79-87, so that's in seller's territory, 100% and 19 days. So condo market is hot, and you probably have seen that or experienced that if you're looking for a condo in the 416. So I'd like to step back and take a look at the trend, because we can get caught into what happened last month, what happened last week, what happened in this neighborhood, what happened in that neighborhood. But if you take this, call it 30,000 foot perspective of the GTA over the last 12 years. So far, if you look at 2017, we are at 87,513. December looks like to be pretty active just because there's more listings, people are trying to sell or buy before the new mortgage rules kick in on January the 1st. So there'll be some, probably I'd say around 5,000, but we'll see what happens. Anyway, so that'll put her at 92, 93. So if you look at historical trend over the last 12 years since 2005, 2016 was a record year, 113. The second highest was 2015 at 101. And then you get into 2007, 2014, they're pretty close, 93, 92. So this year, if we're to have another 5,000, 6,000, somewhere there, that will put us probably at the second, third best year in the last 12 years. So again, it's important to look at trends and not just get caught up with the monthly numbers, quarterly numbers, because they do fluctuate, but it's always good to look at a trend. So this year, obviously, we started extremely hot in the first quarter. Then the Fair Housing Plan came into effect. Things have cooled off. People sat on the sidelines, and then they've come back since the fall market in a balanced territory, which, again, averages out by the time December numbers come in. I think we'll probably end up at the third, maybe fourth best year over the last 12 years. So the real estate market is still healthy, it's strong, and again, it's driven by jobs, employment, low interest rates, and migration into the GTA and people wanting to live in this city. So there are a few points that I wanted to bring up. The new mortgage rules, they're kicking in a couple weeks from now, January 1st. There's a lot of misconception out there. So today, if you are buying with less than 20%, regardless if you choose a 5-year fixed, 5-year variable, or whatever term, you have to qualify at the benchmark rate, which is the higher interest rate. The Bank of Canada, I should say the government wants you to qualify at a higher interest rate if you have less than 20%. If today you're getting a variable mortgage, 5-year variable, you're getting any term that is not, I should say less than 5-year fixed, so 1 year, 2 year, 3 year, 4 year, fixed or a 5-year variable, today, you would have to qualify at the benchmark rate. So again, that is a higher interest rate. The difference is in January 1st, 2018, if you have 20% down or more, and you want to get a 5-year fixed, instead of you qualifying at 3.3 or whatever the interest rate is, you would have to qualify at the contract rate. So let's say 3.3 plus 2 percentage points, or the benchmark rate, whichever one is higher. I really don't think that is going to be a big change impacting the Toronto market. We'll have to wait and see. But I think with every rule change, and we've seen this in the past, buyers and sellers do hesitate to figure out, see how things going to work out, how the market will change, and then they will adjust, adapt, and get on with it. So what I see in January and maybe February, we'll see. I think there'll be some good buying opportunities for my investor clients and people who are looking to buy homes to live in. Because again, the people who will want to sell will need to sell, and some buyers will hesitate because they think or they believe that the market will correct or will drop because of the new mortgage rules, which I don't believe the case will be. Because if you look at the housing market, the think of it as a stool. It's built on jobs. It's built on I should say relying on jobs, good job numbers. It relies on good I should say affordable interest rates. It's the immigration, the population migrating to the city. All those factors remain unchanged. Now we'll see the Bank of Canada might increase the benchmark rate by another quarter point next year, depending on what the U.S. Federal Reserve does. But a quarter point here or there is not going to break the banks. And this is why the Bank of Canada, sorry, I meant the federal government, is mandating everybody across the board, whether you have 5-year fixed, 5-year variable, 20% down payment or less, would have to qualify at a higher interest rate. So the sky is not falling. I still see strength in the housing market. Yes, we will not appreciate it to 30%, which was completely unhealthy and unsustainable. But we're in a good spot. I think 5%, 7% annual appreciation is very good, healthy, and sustainable over the long term. If you have any questions, please feel free to connect and reach out, and I would love to discuss your real estate needs. If you like this video, please like and share. Thank you so much, and have a great day. Till next time.